Leading our market segment today, Wall Street giant JP Morgan has issued a significant warning about Tether, the world's largest stablecoin issuer. According to their analysis, Tether may need to sell off some of its Bitcoin holdings to comply with upcoming US regulations. This could have major implications for the crypto market, given Tether's massive $142 billion market cap and 60% dominance in the stablecoin sector. JP Morgan's research reveals that Tether's current reserve composition falls significantly short of proposed regulatory requirements, with only 66% compliance under the Stable Act and 83% under the Genius Act. These new regulations would force stablecoin issuers to maintain strictly high-quality, liquid assets as reserves, potentially compelling Tether to convert assets like Bitcoin and precious metals into more traditional investments such as treasury bills. In response to these concerns, Tether has emphasized their proactive engagement with regulators and highlighted their robust financial position, including $20 billion in equity and quarterly profits exceeding $1.2 billion from U.S. Treasury investments. In a significant shift in state-level financial policy, North Carolina has become the latest addition to a growing movement of U.S. states exploring cryptocurrency investments for public funds. The state's new bill, introduced with the backing of House Speaker Destin Hall, proposes allocating up to 10% of its general and highway funds into digital assets, specifically targeting cryptocurrencies with substantial market capitalization. This legislative initiative places North Carolina among 19 other states currently considering similar measures, with many focusing on integrating digital assets into state retirement funds. The momentum has already produced tangible results in Wisconsin and Michigan, where public employee retirement portfolios now include cryptocurrency investments. The North Carolina proposal stands out for its specific focus on high market capitalization cryptocurrencies, effectively limiting investments to Bitcoin at present. Speaker Hall emphasized the dual benefits of potential positive yields and positioning the state as a technology innovation leader. This state-level movement gained significant traction following President Trump's executive order promoting federal cryptocurrency stockpiling initiatives. Utah has emerged as a frontrunner in this trend, with its legislation already clearing the State House and advancing to the Senate. For viewers, this development represents a significant shift in how traditional government institutions view digital assets, potentially affecting public funds management and future investment strategies. Whether you're a taxpayer, public sector employee, or interested in financial markets, these policy changes could impact state financial stability and public fund returns in the coming years. In a significant development for cryptocurrency regulation, former CFTC Commissioner Brian Quintenz is set to be nominated as the new head of the Commodity Futures Trading Commission under the Trump administration. Quintenz, who previously served as commissioner from 2017 to 2021, has built a reputation as a strong advocate for cryptocurrency innovation and sensible regulation. During his initial tenure at the CFTC, Quintenz demonstrated his commitment to technological advancement by leading the Technology Advisory Committee and proposing the creation of a specialized self-regulatory organization for the crypto industry. After leaving the CFTC, he joined Andreessen Horowitz as head of policy, where he continued to influence crypto policy discussions. The nomination has received widespread support from industry leaders, including acting CFTC Chair Caroline Pham and the DeFi Education Fund. This appointment could accelerate efforts to give the CFTC greater oversight of cryptocurrency markets, building on previous initiatives like the Financial Innovation and Technology for the 21st Century Act. For crypto investors and enthusiasts, this appointment could signal a shift toward more crypto-friendly regulation in the United States. Quintens's experience in both regulatory and industry roles, combined with his understanding of digital assets, could lead to more balanced and informed oversight of cryptocurrency markets, potentially creating a more stable environment for investment and innovation.
In a landmark shift for cryptocurrencies standing in American politics, the House of Representatives Digital Assets Subcommittee hosted a hearing that marked a notably positive reception for the industry. Under the ambitious title, A Golden Age of Digital Assets, this congressional session represented the first time cryptocurrency has been widely embraced as a legitimate part of the US financial landscape. Industry leaders, including Kraken's Jonathan Yahim, made compelling cases for establishing clear regulatory frameworks. The Republican-led committee, chaired by Representative Brian Steele, emphasized the need to create pathways for responsible digital asset companies to operate within the United States. This marks a significant departure from previous regulatory approaches. Former CFTC Chairman Timothy Massad provided balanced insight, suggesting that while legislative framework is crucial, technical details should be left to regulatory bodies like the SEC and CFTC. The hearing wasn't without political tension, as Democrats raised concerns about President Trump's involvement with cryptocurrency, particularly regarding the Trump meme coin. The timing of this hearing is particularly significant, as it coincides with Federal Reserve Chairman Powell's acknowledgement of crypto-related banking issues, though he maintained a cautious stance on central bank digital currencies. For viewers navigating the crypto space, this hearing signals a potential watershed moment in cryptocurrency regulation. The positive reception from Congress could lead to clearer rules and greater stability in digital asset markets, potentially making cryptocurrency investments more secure and accessible for everyday investors.
In a significant development for digital identity verification, Holonym Foundation has acquired Gitcoin Passport in a deal combining cash and tokens. The merger brings together two leading players in the proof of humanity space, where Holonym was already working closely with Gitcoin Passport's platform of 2 million users. The newly combined company aims to tackle a growing challenge in the digital world, proving that online users are real people, not artificial intelligence or automated programs. Under the deal, Gitcoin Passport will become Human Passport, with 8 team members joining Holonym's existing workforce of 30 people. CEO Shady L. Damity plans to enhance the platform's portability, allowing users to verify their identity across various internet services while maintaining privacy. The system will upgrade its 35 million stored credentials with advanced privacy technology, letting users prove they're human without revealing personal information. The platform has already demonstrated its value by securing $225 million in cryptocurrency distributions and plans to expand into humanitarian efforts, including identity verification for refugees. L. Damity positions the merged company as an alternative to industry leader WorldCoin. For viewers, this merger represents a crucial step towards solving online identity verification challenges, potentially affecting how we interact with digital services, receive cryptocurrency rewards, and protect our privacy in an increasingly AI-driven world.
In a significant development for the cryptocurrency industry, Lido, the leading Ethereum staking service, has unveiled plans for a comprehensive upgrade dubbed V3. This new iteration introduces a groundbreaking vault-based system that could reshape how institutions and investors participate in Ethereum staking. The proposed upgrade centers around ST Vaults, a flexible staking framework that allows for customized staking solutions. This marks a departure from Lido's current one-size-fits-all approach, where all users stake through identical channels at uniform rates. Konstantin Lomashuk, Lido's founder, emphasizes that this transformation aims to establish Lido as a foundation layer of neutral infrastructure, accessible to all participants. The new system is designed to accommodate various staking strategies, from institutional requirements to complex investment approaches like restaking. The upgrade responds to growing institutional interest in Ethereum staking, offering financial firms more sophisticated tools to integrate crypto yields into their portfolios. If approved by the Lido DAO, the governing body of the protocol, the V3 upgrade could be implemented on Ethereum's mainnet by the third quarter of 2025. This evolution positions Lido alongside other modular decentralized finance products, potentially opening new opportunities for yield generation and market participation in the Ethereum ecosystem.
Leading our institutional segment, major crypto investment firm Grayscale has filed an application to launch the first ever Cardano exchange-traded fund on the New York Stock Exchange. This move follows their successful breakthrough with the Bitcoin ETF last year and marks a significant expansion into alternative cryptocurrencies. Under the new Trump administration's more crypto-friendly SEC, Grayscale has become increasingly bold in its product offerings, recently filing for both Solana and XRP ETFs. Unlike these previous applications, which aim to convert existing trust products, the Cardano ETF would be an entirely new investment vehicle. Cardano's native token ADA, currently valued at $29 billion, ranks among the largest cryptocurrencies globally. The market responded positively to the news, with ADA's price increasing by 1.5% to 71 cents. While market experts have been anticipating approval for various altcoin ETFs, Cardano wasn't widely expected to be next in line, despite its popularity.
A disturbing trend has emerged in the cryptocurrency space as investors lost over $500 million to sophisticated social media scams in 2024, according to a new report from Merkle Science. The fraudsters primarily targeted social media platforms using compromised celebrity accounts to promote fraudulent cryptocurrency projects. High-profile cases included the hack of soccer star Kylian Mbappe's social media account, where scammers promoted a cryptocurrency that briefly reached a $460 million value before completely collapsing. Similarly, music artist Wiz Khalifa's account was used to promote a fake token that reached $3.4 million before becoming worthless. Robert Whitaker from Merkle Science warns that these are not random incidents, but carefully orchestrated operations that exploit public trust at scale. The research shows that X, formerly Twitter, was the primary platform for these scams, accounting for 75% of attacks, while YouTube hosted 19% of similar incidents. For everyday social media users and potential cryptocurrency investors, this serves as a crucial warning about the sophistication of modern digital fraud. Even when promoted by familiar celebrities, cryptocurrency investments require thorough verification. Before making any investment decisions, regardless of who promotes them, ensure you conduct proper research and verify the legitimacy of any cryptocurrency project through multiple reliable sources. Remember, if an investment opportunity seems too good to be true, it usually is.
And now moving on to our blockchain technology lessons, kicking off with Part 2, Cryptographic Fundamentals. Cryptography is the lifeblood of blockchain technology, enabling secure, transparent, and trustworthy digital ledgers without central authorities. To understand blockchain, we must first grasp the cryptographic principles that power it. At the heart of blockchain cryptography lies the hash function, the fundamental building block that keeps everything secure. Imagine feeding any piece of information into this function, whether it's a simple message or a complex transaction. What comes out is always a fixed-length code unique to that specific input. Here's what makes it special. If you feed in the exact same information, you'll always get the exact same code. But change even one tiny detail in your input, and the output code becomes completely different. This dramatic change from a tiny alteration is called the avalanche effect. and it's one of the key features that makes blockchain so secure. Hash functions serve multiple purposes in blockchain. They create unique identifiers for blocks and transactions, link blocks together in an unbreakable chain, and play a key role in the mining process. Another crucial cryptographic element we need to understand is public key cryptography, which enables secure ownership and transactions in the blockchain. Think of your public key as your blockchain address. Anyone can send assets to this address, but only you, with your private key, can initiate transactions from it. This system elegantly solves the problem of proving ownership and authorization in a decentralized network. Building on public key cryptography, we have digital signatures. Every transaction in a blockchain is signed using the sender's private key, creating a digital signature that can be verified using their public key. This process ensures that transactions are authentic, cannot be denied by the sender, and haven't been tampered with. It's the cryptographic equivalent of a wax seal on a medieval document, but infinitely more secure and verifiable. As we move deeper into blockchain's cryptographic foundations, we encounter an elegant and clever digital filing system. This is what we call a Merkle tree, a brilliant innovation that helps verify and secure vast amounts of data in the blockchain world. Picture this. Every transaction in a blockchain is hashed to create a unique code. These hashes are then paired up and hashed together to create a new hash, which represents both transactions. This process continues, with pairs of hashes being combined into a single hash, moving up the tree until you reach one final hash at the top, known as the Merkle root. This smart design means that when someone needs to verify a transaction, they don't have to wade through an ocean of data. Instead, they can trace back a branch of the tree, making the whole process as effortless as following breadcrumbs home. It's like having a magical map that can instantly tell you if something belongs in the blockchain family, saving both time and resources. The cryptographic innovations don't stop there. Advanced techniques like zero-knowledge proofs are pushing the boundaries of what's possible in blockchain. These allow one party to prove they know something without revealing what that something is, a concept with profound implications for privacy and scalability in blockchain systems. Lastly, it's worth noting the role of elliptic curve cryptography, ECC, in modern blockchain systems. Imagine you're at an amusement park, standing in front of a roller coaster like no other, the ECC roller coaster. This isn't your typical thrill ride. It's a journey through a mathematical landscape known as an elliptic curve, a complex yet beautiful mathematical object. But before we embark on this adventure, let's understand why this ride is so important in the world of blockchain technology. The ride takes you through twists, turns, and loops, each determined by the ticket you hold. At the end of this exhilarating journey, you come to a stop at a specific point. This endpoint, your public key, is where your ride concludes. It's like a unique location on a map, determined by your private key journey. Now, here's where the magic happens. Anyone can join you on this roller coaster. They can see where you ended up, your public key. But reversing the ride to figure out how you got there, your private key, is a different story. It's like trying to solve a complex puzzle in reverse, known as the discrete logarithm problem. It's so challenging that even the most powerful computers would take millions of years to crack. To understand why this one-way journey is secure, picture this. Imagine trying to figure out how many hops it took to get to your public key. It's like reversing prime number multiplication. It's easy to multiply two large prime numbers to get a product, but reversing that process to find the original factors is incredibly hard. This is due to the fundamental theorem of arithmetic, which states that every integer greater than 1 either is a prime number itself or can be factorized into a unique product of prime numbers. In the world of Bitcoin and blockchain, this roller coaster ride is analogous to transactions. When you want to send your digital currency, you're sharing your public key, the endpoint of your ride. Others can verify your transaction using this point, but only you, with your private key, can sign the transaction to make it valid. It's like proving ownership of your ticket without revealing it. The security of ECC, much like the safety of your ride, is based on the fact that forward computation, encrypting, is easy, but going backward, decrypting, is nearly impossible without the ticket. This makes ECC a perfect fit for blockchain technology, ensuring transactions are secure, verifiable, and private. As we progress through this course, you'll see how these cryptographic building blocks come together to create the secure, decentralized systems that are blockchain networks. From the basic hash function to advanced zero-knowledge proofs, each element plays a crucial role in maintaining the integrity, security, and functionality of the blockchain. Understanding these cryptographic fundamentals is not just academic, it's essential for anyone looking to work with or develop blockchain technology. As we move forward, keep these concepts in mind. They are the foundation upon which the entire blockchain revolution is built.